What you are about to watch is a lion's wealth management process as it pertains to taxes. Now there's a lot that goes into not only your personal wealth front, but the management of it. Now taxes are just one piece of the puzzle, but I would like to say that they are a vital piece of the puzzle that you have to be managing, looking out for, or it's going to come back to bite you in the future. That's what we want to be talking about today, is the process that Lion's Wealth goes through to make sure that we can keep taxes low today, tomorrow, and into the future. Enjoy! Step number 1 is to understand last year's taxes. You see, last year's taxes can actually tell us a lot about where we're going in the future. Now, it really starts with filing your taxes, so that was obviously a big piece of it, and there's a lot there that has gone into taxes now. So once we have filed it, we understand where we have been with income, deductions, and a lot of different aspects. So we take last year's taxes and we're going to plug it into our calculators. So this is where you can pull up your tax calculator and you can start going through and plugging in the details. So we have income streams here. So we have Social Security, we have pensions, we can plug in your W-2 income, we can plug in your rental income, your business income, we can plug in 1099 income. We can plug that all into your tax software and really get an understanding of where you have been. So also, what we can be working with here is deductions. So in this case, we can be looking at how much you took in charitable deductions, what that means for a standard versus an itemized deduction. You see, that also comes back to knowing where we can go, because some taxes and some things are based upon your adjusted gross income. Some are based upon your taxable income, and knowing those areas of your AGI versus taxable income really comes back down to when we take a look at our charts here, and especially not only the tax brackets, but then say other things that we need to know, like Medicare premiums. You see, Medicare premiums change by how much income we have. And so what is a premium payment that you are having could spike just because you have more income. So while they don't call that a tax, that's basically what it is because you are making more income, you are going to pay more for the privilege of Medicare. So those aspects are what we can really start figuring out from where we have been. So looking at last year's taxes is going to be a vital element to that. So we finished putting in all the numbers into the tax software, and what will happen then is we can actually spit out a lot of information from your marginal tax bracket. So whether in this case we're in the 22% bracket for the marginal taxes, effective taxes, what you're effectively paying your dollars on. So in this case, for this example, if we're in the 22% bracket, the effective bracket is about a 15%. So that's what we're paying the money on. And then we take a look at state, because for some higher taxable states, so California, New York, here in Minnesota, we have to be very diligent about taxes on the state level as well, because that adds in another element. Well, we take a look at all of this, and then we really come back down to knowing the brackets, so where we're at for the federal level, where we're at for the state level, and every dollar that we go to and have come in extra on a yearly basis, especially for this year, it's going to add to this. So we need to know if we're going to be jumping up to a new tax bracket just because we added in another dollar of income. But that's not all. You can see the other aspect here that we have long-term capital gains. Now, long-term capital gains are vital for really going through and understanding, should I be selling this year or should I wait? Should I be taking losses and harvesting losses in the bad time, or should I be postponing those sales until a future date when I'm actually going to get a better outcome just based upon where my taxes are at. So you see, we can actually look at last year's taxes and we can really figure out quite readily where we have been. Now that is vitally important to figuring out the future. And that leads us to step number 2, which is to project your current year taxes. You see, when we look at the past, we can actually start to make changes to the present year. So we can start saying, all right, well, we had $50,000 that we took out of our taxable retirement accounts. Well, maybe this year we're still going to be taking out that $50,000. But you know what? Maybe we want to do another project. So we should be taking out an extra $25,000. So if we go back in and actually look at this and we can reproject it now, saying now we have $75,000 that we've taken from retirement accounts versus just the 50, that is going to change dramatically what our taxable income is just because we've taken out another $25,000. So we can go in and make adjustments to the current year based upon what we know. So if, say, last year we had a lot of deductions that happened just based upon charitable giving, we may not have them this year, which means that you may actually be claiming a standard deduction versus an itemized deduction. Now that's what we go through now to make the adjustments, to look at where we're at today. So this again can be vitally helpful so that we know when we come back to where we are, at today, we can say, all right, well, we were in the 22% bracket, but making those changes that we have talked about here, that's going to add in this case, another $3,000 of taxes. So going back to our brackets here, we know that that $3,000 of tax in general is still going to be in that 22% bracket. But let's say we have, now we can go back into here and make some changes. We have the $25,000 that we've added in here, but we also have some other income that we've had in. So we had, just because of the nature of where we're at this year, we had $50,000 of short-term capital gains. And just by changing that, those $50,000 of short-term capital gains, we added another $11,000 of tax, and we've jumped up a bracket already. We're no longer in the 22%, we are now in the 24% bracket. So knowing those numbers, maybe we'll say, well, we should back off on some of the IRA money or that retirement money that we were taking, because we know we have more that's going to be claimed from the short-term capital gains, and we don't need all of that money that we're going to be selling. So why don't we take some of that instead? So what you can start to see here is that when we know where we have been, we can project where we are at today, knowing the information that we know and where we're at for income, what our needs are going to be. And then we can start looking forward into the future. But it's all based upon the projections here, so knowing where we're at currently. That leads us to step number 3, which is to map out your current year taxes. You see, like I've been talking about here, we can actually go through the current year, start making those adjustments that we need. And when we know that we need to have $25,000 extra from a retirement account, when we know that we're going to be taking $50,000 in short-term capital gains, well, then we can start looking at what that amounts to as it comes back to all the different levels. So what are our charitable deduction levels? Should we be giving cash this year, or should we be giving something else like maybe a vacation property, real estate, cars, other tangible goods that we can have and leave as a legacy to charity? That can all come back down to knowing our limits here for how much of a charitable deduction we can claim. But then also what it does is now we can sit here and say, well, we have all these different types of taxes that come in. So remember when I said that we have the Medicare tax? Well, we do have that if the brackets of your premiums go up. So right now we're good. Right now, we don't have an issue with an increase in Medicare tax. But if we make changes and have too much income, now we may be jumping up into that bracket that says we may actually now have more in Medicare premiums just based upon how much income we've had in retirement. Well, that's not all. We can come down to any credits that you may be able to collect on. We have child care tax credits, saver credits, Roth conversions. You see, when we know those informations of where we are at for the different brackets, can you be doing a Roth conversion, or even more so, a Roth contribution? Now things get interesting, and this is the map that we go through here. So we look at where we're at on all the different deduction levels here. We can map out actually how much money we can be utilizing this year before we get to another bracket. So in this case, we have $50,000 extra that we can be taking out. Now that we're in that 24% bracket, we can actually be utilizing that as part of it. So that $50,000 of short-term capital gains, that's the top end that we could do and still do a Roth conversion and stay in the same tax bracket. So that is why we can, we have to know where we are at. We map out the things and changes of this year so that we can actually take a look at all the different dynamics of where you're at today based upon the map of all the different credits, all the different advantages that you have in the tax bracket that you are in today. And that brings us to step number 4, which is to map out your income and your expenses for the current year. Okay, so we've gone through the taxes, we've gone through and started to put together a semblance of process as to where we're at currently and some of the changes for this year. But that's not good enough when it comes to projecting the future. So what we do then is we take the projections that we have for taxes and we're going to drop them into the planning software then. So this is where we can start mapping out the future. So we look at our current income streams. Now these are our guaranteed income streams here, and the money that we have coming in every single year that is going to be guaranteed, whether from Social Security, pensions, things like that. Well, then we can also take a look at the withdrawals that were happening. So you can see that there's going to be some years that we're going to take out more in withdrawals for others. So that $50,000 that we had anticipated for short-term capital gains, well, that can be in here. The $25,000 extra that we have for just that IRA retirement plan distribution, that can go into here. And we can start saying which accounts can we be taking from that have additional withdrawals that we need to be making in the accounts. So we go through that process as well. And then we can actually be going back, when we bring back through everything here, we go to the expenses. Now the expense category talks about living expenses that we need. This is basically just coming back down to the mortgage, the bills that we have, the bare bones necessities just to get by on a yearly basis. Well, we can add in some other expenses here as well. So those are additional items that we need to be putting forth just for, again, normal living. Well, what is going to be the tax on that? So we can actually sit here and calculate out the tax this year, but then if things revert back, we don't necessarily have that $50,000 of extra income from short-term capital gains this year. Well, things revert back. So now we're not paying $31,000 between federal and state. Now we're paying, well, in this case, $14,000 next year for the next year's taxes. That's based upon a reversion back to where we were. Now, obviously tax brackets change as well, and we're going to have them changing in 2025 when we have the sunsetting of the Tax Cut and Jobs Act. So there will be changes to happen, and knowing that, well, we can still project that. So you can see all of a sudden taxes have jumped up here just because of the fact that a reversion back to the old tax brackets. Now that also comes into play in saying if we know the tax brackets that we're going to be in the future, just obviously as much as we can predict, well, then we can start figuring out how can we start managing taxes more. And when we talk about managing taxes, that really is the crux of what it means to be having a plan in place for your taxes. You see, here at Lions Wealth, we go through many different aspects of the wealth plan. So taxes are just a piece of it. Investments are just a piece of it. But then we go into a lot more of the advanced planning that comes around wealth enhancement, charitable gifting. We have estate planning and wealth transfer. We also have wealth protection. So all of those play into your plan. And the whole idea, the big picture here, is that you can have an impact and create that impact for yourself, for your family, your community, and your company. You see, by creating that impact, that is where we can now start to say, well, how can we be blessing those we care about? How can we be leaving the legacy that we want and care about? All of that comes back down to, again, knowing where we're at for taxes and planning for the future. So you see, it's not just one piece of the puzzle. It encompasses a lot of the puzzle. Now, that alone is not necessarily the answer. You see, when we know that taxes are going to be changing, as we do now, what can we do about it? And that leads us into, and that goes into step number 5, managing your tax buckets. When we talk about last year's taxes, when we talk about this year's taxes, that's a piece of the puzzle. And what we have been talking more and more about is that impact that you can be leaving, the legacy. Now, what could happen if taxes go up and you're not prepared for them? Well, we have to pay more taxes for the income that we are taking, which is not necessarily a great deal. Well, how can we avoid that then? How can we sit here and say, let's actually step back, let's plan for our taxes? You see, when we take a look at income brackets, like we talked about here, we can actually look at saying we're going to be paying this much tax this year, and we're in this tax bracket this year, but in the future years, our tax brackets are going to change. Well, if we know that we're going to have sunsetting of tax laws, if we know that we're in a very low tax environment right now, and we need to be increasing them for, say, government debts in the future, that's something we can actually plan for. Now, the planning for that is quite different based upon each individual and where they are at. So this is where you get down into the details of your personal tax plan. But here's the thing, when we do this well, we can actually start to see the positive ramifications, the positive outcomes, and how you can have that larger, greater impact. So let's take a look at this here. We take a look at, again, where we're at today before we make changes. And we have some money in retirement accounts. We have some money in investment accounts. And then we have some other assets that are out there. In this case, let's say a house. Okay, that's a piece of the puzzle. Well, then we can come back up and look at the tax types that we have. So we have a small portion of taxable income. We have a small portion of tax-free income. Well, we have the largest portion of the wealth here is basically in retirement accounts. Now, that's our tax-deferred buckets. Now, what we know about tax-deferred buckets is the fact that, yes, we will have a required minimum distribution at age 72. So we know that we are going to, by law, having to take money out of the accounts. What we also know is that if we have Social Security, which is taxable, if we have pensions, which are taxable, and then we need to take out an additional amount, well, most likely in this scenario, we will be taking it from a retirement account. Now, this is something that many of you actually have put money into and have this as one of your largest buckets of tax. So this is actually not unheard of, that your retirement accounts are going to be the largest portion of what you're going to be using in retirement. Well, that's not necessarily a good thing, because if we raise taxes, Social Security will get taxed more because of the tax brackets we're in. Your pensions will get raised more for the taxes because of the bracket that we're in. And every dollar from the retirement plan that we're taking out is going to be taxed in a higher bracket. Well, that's where we can do some planning. That's where now you can sit here and say, let's plan for it today, knowing things are going to change in the future. Well, what is that? Well, like I said, it's managing our tax buckets. So when we actually come back up to here and say, what would it look like to start balancing those buckets? And we can do now a side-by-side comparison. So what we have done is we've actually taken those retirement accounts and systematically over a couple of years here, we have transitioned some of them into the taxable bucket, and we've transitioned some into the tax-free bucket. So now, when we take a look at all the different details of what this looks like here, no longer are we in a difference of saying the majority of your money that you're going to be using in retirement would come from retirement accounts. Now we can sit here and pick and choose on a yearly basis. So if this year is going to be a higher tax, basically a tax event because we have to realize some capital gains. Maybe we do have a sale of a second house that's going to cause some additional property taxes or some additional income taxes to be owed on that. Those are all pieces of the puzzle. But then we can take from other avenues if we need an additional dollar. So in this case, maybe we take more from the tax-free bucket or even from the taxable bucket just based upon the year. So now we can pick and choose. And when we look to equal the tax buckets, we have a lot more options when it comes to how we work with taxes in the future. And when we go back to seeing if we do nothing, if we just take a look at where we're at today and how the assets are growing, in this case it's just $1 million that we had here, just as an example. But let's say we had some spending down that was occurring over the years. So we spent it down to about $870,000. We had some growth, we had some spending, and that is where we ended retirement. But let's say, just by doing a little planning, and we've made sure that money is in those brackets. So this is again from today. So saying today, yes, we pay more in taxes. So we're actually going to be putting more weight into taxes today when we're basically in a lower tax bracket compared to where we will be in the future. That then comes back down to saying we can start to right the ship of your tax buckets. And just by doing those tweaks and actually making sure that we have a third, all of a sudden we have not just have 870,000 left, now we have almost 1.4 million left. And nothing else has changed in this scenario. Our needs have not changed. The different tax brackets have not changed. But what has changed is how we manage those brackets, because some years will pull more from the taxable accounts, some will pull more from the tax deferred accounts like your retirement accounts, and other years we will be pulling more from the tax-free buckets. Now here's the other nice thing. When we take a look at this, we can also add in, say, life insurance as part of one of those tax-free buckets. And when we come back to the assets that we have here, let's just say we did that. We added in a life insurance piece that we can actually be using loans from and can take as income over the years. So again, loans are tax-free, and we can actually take from the policies at times in a tax-free manner. So not only did we say we increased the overall net worth, but we also added in this case, let's just say a $500,000 policy. So now we have not only the $500,000 of life insurance on top of the assets, on top of what you can be pulling out tax-free. So you can start to really understand this is a powerful, powerful tool to make sure that you can actually continue to keep growing your assets. So it's no longer just the investments. The investments are going to go up and down based upon the markets. and what you're invested into. But if we can start to pick apart the tax brackets, if we start to understand where you have been, where you are at today, and where you are going, and we start to right the ship of your tax buckets, that is how you create an impact with your wealth. If you want more videos about the process you need to be going through with your wealth plan, whether it's investments, whether it's wealth transfer, wealth enhancement, check out this video right here as you can continue looking and diving into the process. Also, as you have questions, you can click the link next to me right here, and what this will do is allow you to schedule time with myself and my team, and we can deep dive into your taxes, your personal situation, and what that means for your wealth plan. Remember, keep having an impact on your family, your community, and your company through a well-defined wealth plan. And I look forward to seeing you on future videos.